The Peterson Institute, it's my pleasure to open the session with Klaas Knot. Klaas Knot, of course, is the governor of the DNB, the Dutch central bank. He's done about everything in his career. He's been at the IMF. He's been, of course, in all the BIS, Financial Stability Board, and all that machinery. He's also been at the Ministry of Finance in the Netherlands and before of different bases in the kind of world most of us are familiar with. But importantly, he's also coming from Groningen. I'm not trying to speak it the Dutch way, in the north of the Netherlands, so not in Holland. And that's a special place because that's a place where a number of economists come from. Many of you know Willem Buiter and others, Bart van Ark. Jacob de Haan, who is now at the central bank in charge of research, but also Wim Duisenberg. So the fact that the former head of the ECB was from there may or may not be a sign that something to be left for later. So thanks a lot, Klaas, for putting us on your schedule, and you now have the floor.
So thank you. I did have, yeah. Check. No. Sorry. Wrong way. Yeah. Okay. Now I know which way it moves. Okay. Well. Thank you for having me here, Nicolas and others. And what I will do is I'll have a couple of prepared remarks where we will begin with. And these are on easy money, uneasy finance, the relationship between monetary policy and financial stability. And then afterward, obviously, I'm happy to take some questions and we can further the debate. My starting point today is that 10 years ago, the financial system was on the brink of collapse. Within just a couple of weeks, well-known and systemically important financial institutions either failed or they teetered on the brink, on the abyss. Activity in several key financial markets ground to a complete halt, and soon after, the world economy would enter into a very deep recession. Well, to remind you of the extreme circumstances of that time, let me show you the front page of the Financial Times from 10 years ago. So this is the Financial Times of 24 September 2008. And you see that these headlines were dominated by the frenzied efforts of the US government and the Fed to deal with the fallout from the Lehman Brothers collapse. Well, we all remember probably the unimaginable developments that happened in those weeks. We probably also all remember the pain of the Great Recession that hit the global economy in the following years. But what I also remember is the global commitment and the cooperation among policymakers. Deep uncertainty was plaguing these authorities, but I think at the end of the day, a combination of extraordinary measures, including interventions, capital support, liquidity injections, all these interventions eventually succeeded in restoring financial stability. And an unprecedented monetary stimulus was provided through a range of conventional and unconventional tools. 10 years later, we now stand at vital crossroads. The supervisory reform program has made important progress. Monetary policies are now being normalized. So what I want to do this afternoon is to take stock of the current challenges. And I would particularly like to focus on the importance of a robust financial system for conducting monetary policy. And in doing so, I want to convey two main messages. First, that a sound financial system makes life for monetary policy makers much easier. It limits the effects of financial shocks on the real economy, it strengthens monetary transmission channels, and it also reduces the unintended consequences of monetary policy actions. Obviously, the reverse is also true. A weak financial system can cost central bankers many sleepless nights. Secondly, against the backdrop of an environment that is of a monetary environment that is likely to remain accommodative for some time, In my view, we therefore need to further strengthen the financial system. And to do that, we need to further improve the financial regulatory framework in the coming years. And I will argue that the current financial system is in much better shape than a decade ago, but that still important risks remain. I will argue that international regulatory authorities first need to maintain strict micro and macro prudential regulation, secondly, must seek further improvements in policy implementation, and thirdly, should also adapt to risks shifted outside their perimeter. Let me briefly recall the financial, economic, and policy circumstances that allowed the global financial crisis to develop. In the decades before the crisis, the global system changed profoundly, and this was the result of deregulation, increasing competitive pressures on banks, and also increasing financial globalization. These trends have led to a greater role for market finance and a stronger interconnectedness within the financial system. During the same period, the macroeconomic environment also underwent structural changes. This happened on the back of accelerating globalization, the emergence of new players like China, and technological progress. Against this background, large global flows of savings and investments pushed down long-term interest rates in the US and other advanced economies. Accommodative monetary policies further allowed for financial risk-taking. It has been argued that this great moderation allowed a leverage build-up that ultimately threatened financial stability and hence macroeconomic stability. In the regulatory policy sphere, a widespread trend towards deregulation loosened the reins on risk-taking in the financial sector. Microprudential supervision was not well equipped to address this increased risk-taking. In addition, a macroprudential orientation of regulatory policy addressing systemic risk was almost completely absent at that time. In this environment, misaligned incentive prompted widespread risk-taking in the financial system, and in combination with high economic growth, important imbalances developed. When the crisis erupted, banks did not have sufficient capital to absorb losses, and authorities were not adequately prepared to handle failing banks. The imbalances spread almost instantaneously across the global financial system as a result of the interconnectedness of financial institutions and markets. Now, these patterns are not specific to the global financial crisis, as economic historians have documented. Typically, financial crises are preceded by booms where factors like high growth, innovation, and increased risk-taking interact. In a recent paper, however, Ben Bernanke added yet another element, and that was the excessive reliance of financial institutions on short-term wholesale funding. And this new element, I also believe, explains why the global financial crisis was more extreme and why it also had more severe effects on the real economy. When the crisis erupted, it was clear that we needed new policy toolkits. In the last 10 years, therefore, a comprehensive reform program has been developed under the leadership of the G20, the Financial Stability Board, and the Basel Committee on Banking Supervision. These reforms have made financial institutions better equipped to deal with future shocks. Thanks to these reforms, banks today hold significantly more capital, which is more readily and more easily available to absorb losses. Banks also have stronger liquidity positions, and they have strengthened their governance and risk management. Prudential policies increasingly include a macro-prudential orientation with a stronger focus on financial stability. Risks originating in the shadow banking sector are better appreciated, and over-the-counter markets have become more robust and more transparent. In addition, resolution management has emerged as a new toolkit to address too-big-to-fail distortions. And it also became clear that traditional monetary policy responses were not sufficient to deal with the great recessions. As policy rates were cut to their effective lower bound, further monetary accommodation was achieved through unconventional tools such as forward guidance, longer-term refinancing operations, and asset purchases. And with the help of these new tools, monetary policy contributed to fixing a dysfunctional monetary transmission mechanism, to supporting the recovery, and averting deflation risk. Today, the financial system is more resilient, and the global economy is enjoying a period of strong economic growth. However, important challenges remain for both monetary and regulatory policymakers. A framework that I consider very useful for guiding policy actions is based on the following very simple three key elements. First, the necessity of policies. Do circumstances require action by authorities? Secondly, the effectiveness of the instrument. Can the proposed policies achieve the intended objectives? And thirdly, the possible unintended consequences of some of these interventions. In my view, both monetary and regulatory policies need to be based on such criteria as guideposts for policy making. Let me apply now this framework to monetary policy first and focus on the interplay with financial stability. And my main point here is that a sound financial system makes life much easier for monetary policy makers. Let me elaborate. First, a sound and stable financial system will reduce the need for monetary policy actions aimed at macroeconomic stabilization. The global financial crisis and the ensuing Great Recession have shown that shocks emanating from the financial system can have a devastating impact on the real economy. Similarly, a financial system experiencing stress amplifies the effect of shocks originating in the real economy. And both mechanisms then lead to larger deviations of output from potential, of inflation from target, compared to in an environment in which the financial system had remained stable. And in turn, that then calls for more monetary policy interventions to stabilize output and inflation. Second, monetary policy is also more effective when the financial system is sound. Standard monetary policy determines the marginal financing conditions in the short-term money market. Its macroeconomic effects then depend on several channels through which financial intermediaries pass on these policy rate decisions to the real economy. Especially on my side of the Atlantic, during the European debt crisis, these transmission channels became severely impaired. And this severely restricted the ability of policy rate cuts that the central banks had implemented to stabilize the real economy. Central banks ultimately, as I said, had to resort to unconventional monetary policy tools to restore the pass-through of lower policy rates to firms and households. A sound financial sector, therefore, enhances the effectiveness of monetary policy by improving the functioning of the transmission mechanism. It helps monetary policy achieve its objectives with less effort, and it also reduces the likelihood that the effective lower bound is reached. Third, the more sound a financial system, the less likely it is that monetary policy will have unintended consequences. The converse is, of course, also true. A weaker financial system will make it more likely that monetary policy actions will create these unintended consequences. These unintended consequences can occur through different channels. A first and much debated mechanism is the risk-taking channel of monetary transmission. According to this, monetary policy has a systematic impact on ex-ante risk-taking in the financial sector by setting the universal price of leverage, affecting financial conditions and thereby ultimately the real economy. A prolonged period of loose monetary policy can contribute to the build-up of financial imbalances. And in this sense, and this is up for debate, but persistently low interest rates since the turn of the century have also perceived by some as contributing to the global financial crisis as well. A second mechanism through which persistently low rates affect financial soundness relates to the reduced incentives for balance sheet repair. The more so if macro and micro prudential regulation are insufficiently developed. And this is most evident in a crisis situation, such as the one from which we have recently emerged in the euro area, or, let's say, the crisis of Japan in the 1990s. Monetary stimulus through conventional and unconventional instruments may help to avoid a collapse of the banking sector. But it can also come at the expense of reduced incentives for balance sheet repair by individual banks. It can promote the evergreening of non-performing loans and even regulatory forbearance. In this context, unconventional policy instruments are more intrusive than conventional monetary policy, and they can therefore create deeper distortions that aggravate the risk of misallocation of resources and financial instability. It's often argued that macro-prudential and not monetary policy should be geared toward financial stability risks. But here I tend to agree with Charlie Bean that there are important qualifications to this somewhat Panglossian view of the ability to maintain both price stability and financial stability by assigning monetary policy to the former and macro-prudential policy to the latter. Quote. This implies that an effective macro-prudential policy is a necessary, but it's not a sufficient condition for monetary policy to be effective also in the medium to long run. Central banks must therefore be conscious of unintended consequences of a monetary strategy that keeps policy rates low for a long time. Translating this to the current context, my main takeaway is that as long as inflation remains subdued, central banks are likely to maintain an ample degree of monetary accommodation, but the longer this accommodation is maintained, the more pressure will actually mount on financial regulators and supervisors to be able to preserve financial stability. So what would this mean in practice, and how does it relate to the international regulatory agenda? My key point here is that in an environment in which monetary policy is likely to remain accommodative for some time, it is important that the agenda for financial reforms is pushed ahead along several dimensions. Let me elaborate here also by referring to the same three elements: necessity, effectiveness, and possible unintended consequences. The first question is whether the regulatory reforms that have been adopted are still necessary. Well, I have a very short answer here, and that is absolutely. And I believe we need to even strengthen our regulatory toolkit further. As I mentioned before, the global financial crisis could develop in an environment with high growth and increasing risk appetite, with low interest rates and abundant liquidity on the one hand, and on the other hand, the emergence of new risks due to technological developments and innovation that were not adequately captured by microprudential and macroprudential regulation. The regulatory reforms taken in response to the crisis were thus needed to restore the balance in a previously under-regulated sector. As of today, vulnerabilities in bank intermediation are much smaller and bank resilience is much stronger. However, some of the drivers of the crisis are still present. The total debt of households, firms and governments as a percentage of GDP is now higher than it was 10 years ago. Short and long-term interest rates are still relatively low. And financial institutions and markets remain strongly interconnected. In this context, we should be wary of recent indications of diminishing momentum for regulation. And there are even industry calls for rolling back some of the agreed reforms, to which I clearly would not subscribe. On top of that, I would like to highlight the need to further develop the macroprudential toolkit. The current macroprudential tools are incomplete, and by design they are limited in scope and impact. Almost all jurisdictions have by now established a macroprudential authority, but there is still some difficulty to identify and/or some reluctance to actively develop macroprudential policies and instruments to address risks to the financial system as a whole. The second question is whether the regulatory reforms carried out thus far were effective. Although the early signs of much stronger resilience in the core financial system are encouraging, it's still relatively early days to judge whether this has been enough. Too big to fail incentives have surely been reduced, but few would argue that they have actually been eliminated. The new rules in response to the crisis were also designed in a short time frame, and many reforms progressed in parallel. It is therefore a natural process that after the initial implementation of such a comprehensive set of reforms, policymakers now shift their focus to the phase of policy evaluation. International standard-setting bodies, like the FSB, have to continuously assess the design and the implementation of reforms to see whether regulation meets the objectives while minimizing distortions. And this is actually what we are doing today. It goes without saying, of course, that such analysis should be evidence rather than sentiment-based and focused on better rather than less regulation. The global financial crisis has also shown that international cooperation is key in developing effective regulatory policies. The global financial sector is closely integrated, and national or regional developments create external effects that directly and indirectly affect financial stability in other jurisdictions. Developing a common approach creates a level playing field between jurisdictions, which avoids regulatory arbitrage. The post-crisis reform agenda, but also the creation of a single supervisory mechanism in Europe, are important examples of such successful international cooperation after the crisis. The third question then relates to the unintended consequences of regulatory reforms. And a main concern here is the potential of shifting risks outside the regulated sector as new rules come in. As Charles Goodhart forcefully argued, prudential policies face a so-called boundary problem. Effective regulation can penalize financial intermediaries within the regulated sector compared to those just outside, leading to substitution flows toward the unregulated. For example, when it comes to what we now call non-bank financial intermediation, formerly known as shadow banking, the growth of total assets in recent years has been higher than in traditional banking. It is true that since the crisis, efforts by the G20 and the FSB have resulted in better insight into the non-bank intermediation. Yet, there are still important questions about the potential systemic risks originating from the unregulated sector and how these risks could interact with those emanating from the regulated sectors. So let me conclude. The global financial crisis was a sobering experience that presented an existential threat to financial stability. The potential disruptive effects to the financial sector and the economy at large called for exceptional measures. In those turbulent times, the monetary, regulatory, and supervisory response essentially followed three guideposts. First, authorities did what was needed. Secondly, they implemented policies that were effective. And thirdly, they tried to mitigate unintended consequences. We've come a long way. Financial stability has been restored, and the financial system is more robust than 10 years ago. However, the next 10 years will undoubtedly present new challenges. History teaches that new vulnerabilities will emerge, and the next financial crisis will eventually occur. We cannot assume that financial regulation will always be fully able to prevent the next crisis, because regulatory coverage is never perfect. It's never complete. And new risks can also emerge from other segments of the economy or its financial sector. Technological innovation will continue to change the business model of banks and how they operate within the financial sector. New businesses will emerge along the chain of value creation. These fundamental changes can lead to disruptive innovation and to new operational risks, like cyber, for instance. Such risks are outside sort of the natural domain of regulatory authorities, but they will become increasingly important to financial stability. Financial supervisors should therefore continue to expand their knowledge and enhance their risk monitoring activities in these areas. And this underlies why we all have to remain vigilant and continue to adhere to our strategy of pursuing a sound financial system. It would support and enhance current monetary policies, and it would contribute to containing the unintended consequences. In addition, a well-regulated financial sector would also provide us with a much better starting point than prior to the global financial crisis. Well, little that I said is entirely new. And yet I feel that those words should be heard again. Let me illustrate that with a 2001 quote from the late Andrew Crockett, which was one of the founding fathers of the Financial Stability Board. Perhaps, instead of everything that I said today, these words alone would have sufficed. I thank you for your attention.
So this